Tokenized stocks have existed for several years, but interest in them increased sharply in 2025. Large crypto platforms entered the space, and regulators began to engage more seriously. This has moved tokenized stocks from a niche idea into a developing market. So, what are tokenized stocks? Tokenized stocks are crypto tokens that track the price of real publicly traded shares, such as Apple or Tesla. They allow users to gain exposure to stock prices using blockchain infrastructure, often with 24/7 trading. In most cases, holding a tokenized stock does not mean owning the actual share. Instead, the token reflects the stock's price movement. The most common structure works like this. A company purchases real shares through a traditional broker. Those shares are held by a regulated custodian. For each real share, one token is issued on-chain. Oracles and arbitrage mechanisms help keep the token price aligned with the stock's market price. Because the token holder is not the legal shareholder, there are limitations. Token holders usually do not receive voting rights or direct dividends. Some platforms handle dividends indirectly by reinvesting them, so the token price reflects that value. A smaller group of projects is trying to go further by issuing tokenized shares with full legal rights, meaning voting and dividends are preserved. These models are still early and depend heavily on regulatory approval. Market growth has been rapid. In mid-2025, the total market value of tokenized stocks was very small. Within a few months, it grew significantly as new platforms launched and exchanges listed stock tokens. Several crypto exchanges now offer tokenized stocks to non-US users, reflecting stricter regulations in the United States. Outside the US, platforms can operate under existing securities frameworks, especially in Europe. Regulation became a major turning point in 2025. Some companies received approval to offer tokenized stocks legally to retail investors. At the same time, traditional exchanges have started exploring how tokenized shares could trade alongside regular stocks, as long as the tokens carry the same legal rights. Despite progress, risks remain. One concern is investor confusion. Many users may not realize they are buying price exposure rather than actual ownership. Liquidity is another issue. Although tokenized stocks trade 24/7, volume often drops when traditional markets are closed. Without active arbitrage, prices can drift and spreads can widen. There are also concerns that tokenized markets could fragment liquidity between traditional exchanges and crypto platforms. Supporters argue the benefits outweigh the risks. Tokenized stocks lower entry barriers, allowing global access without a traditional brokerage account. They enable fractional investing, making small allocations possible. And because they are on-chain, they can integrate with DeFi, used as collateral, traded on decentralized exchanges, or combined with other crypto assets. In summary, tokenized stocks are still evolving. They are not yet a replacement for traditional equity markets, but they are no longer experimental. With regulatory interest growing, public markets may gradually move on to blockchain infrastructure. Whether tokenized stocks become mainstream will depend on regulation, liquidity, and how well platforms communicate what users are actually buying. Thanks for watching. If you've got questions or thoughts, drop them in the comments. We're happy to reply. At Mudley Group, we're building a space where anyone can learn trading, improve together, and feel supported, whether you're brand new or already trading. Follow the channel, like the video, and check the description for useful links. See you in the next one.